Good afternoon, everyone. Welcome to HSC webinar, The Valuation Disconnect. Thank you for joining us today. My name is Hung Võ, the Senior Director of Institutional Sales, and I am delighted to be your moderator for your today's sections. And as you may know, what's a fantastic backdrop we have today for today's discussion. The market closed at the powerful rally today and fueled by the significant turnarounds as the foreigner investors shift aggressively back to net buying today. And if you have been looking for the catalyst, the strong momentum sets the perfect stage for our core team, a fascinating market paradox. And despite the earnings fundamentally remain exceptionally strong, and we calculate that the second quarter net profit under HSC coverage surged by 42% year-over-year growth, beating us strongly by 24%. And the stock price across multiple sectors have yet to reflect that true intrinsic value. And to help us dissect why the market is acting so moody and where the deepest mispricing lies, we have a stellar lineup for you. And before we jump into our agenda, we have a few quick housekeeping notes to ensure a smooth session today. First, today's webinar is being recorded, and the presentation materials will be shared with the participant post-event. Second, all attendees' microphone and cameras are muted automatically to ensure clear audio qualities. And lastly, we highly encourage your active participant. If you have any questions for our speaker, at the any points during the presentation, please type them into the Q&A box. And we have the 20 minutes Q&A block at the end where we will address as many of your questions as possible. And now let's look at our main team today. Joining us, we please welcome Dr. Long Pham, our Chief Economist, to take us through the macro momentum. And we also have to welcome Tyler, the Chief Market Strategist. Tyler will try both us to explaining the disconnected and the strategic playbook. And lastly, representative of sales and trading desk, I myself will discuss about the trading tactic. And no further ado, let's start with Dr. Long, our Chief Economist, to discuss about the macro momentum. Dr. Long, the floor is yours. Thank you.
Thank you, Ms. Han. Good afternoon, our valuable clients. It's my honor to start today's discussion with the macro picture, and I also trying to link some of the macroeconomic indicator with the performance of the VN index from my thinking. So that is today is very coincident with the data release of July. So I just try to update for you first the 7-month performance of economic activity of Vietnam. Broadly, we think data is still very supportive for our forecast of 8.5 and the government target of 10%. Firstly, we see the inflation is to below 4.5% from above 4.5 in June. Meanwhile, the 7-month average is still below 4.5 as well, both below our forecast and the central bank target of 4.5%. Second, we continue to see the export and import activities very strong, with export and import rising 25 and 41% in July, and translating into a high growth in the first 7 months of the year. Nevertheless, trade deficit continue to widening to 20.5 billion in the first 7 months of the year, particularly due to the very strong import demand, especially from the domestic sector, also for the electronic items. At the same time, due to strong trade activities, the manufacturing sector continue to show robust growth in July, with PMI rising to above 52 level, marking the 13th month of expansion in the private manufacturing sector. Together with that, FDI continue to be very solid, with 7-month commitment rising 58%, well above our forecast for the whole year. and implementation also rising at double digit at 11.8%. Not only the FDI public investment also very resilient and accelerating to almost 26% in July and about 18% in the first 7 months of the year, showing a sign of improvement in public investment. Also, retail sales rising 14.5%, very high level in July, and 13% in the first 7 months of the year, also exceeding our forecast of 12%. At the same time, we continue to see the state budget post a very significant surplus in the first 7 months of the year. This is the macro heat map for the last 12 months. Basically, we only have some of the key issues remaining regarding, firstly, to the inflation, and secondly, the trade deficit. Some of the big improvement regarding to the interbank rate declining to below 1% as the end of July, and the VN index still, however, showing a little bit of poorer performance on year-on-year basis compared to the last 12 months. Regarding to the 7-month performance of this year, there's many indicators outperforming the same period last year. However, there's some point that we note. Firstly, as we mentioned about the trade deficit of almost 21 billion versus last year 10 billion in trade surplus. And secondly is in terms of the electricity generation, only grow at 2.5% compared to last year, about 10%. Regarding to the performance of key indicator performance and the target set by the government for achieving the 10% growth. So basically, we see a lot of momentum still on track of the government target. For example, like both export and import exceeding the government target for the next 5 years on average goal of export of 15% and import of 12%. However, we note that the import is still rising much quicker than export. That is some of the things that which we haven't seen the turning point for trade surplus yet. Secondly, we see the retail sale is recovering very quickly in the last few months, and also in line with the government target of at least 14% for nominal growth in the next 5 years. And together with that is the manufacturing activity also quite in line with the government target of 12%. That is the indicator, the criteria for 10% growth. Some of the point that we see is still lag behind is as we mentioned about the electricity, only 2.5% in the first 7 months versus the government target of 11% for the growth in the next 5 years. And also in terms of the international tourist arrival, despite rising by more than 10% in the first 7 months of the year, but annualized rate is just about 25 million, and we still see a very far way to achieve 45 million by the end of 2030. Regarding to Vietnam trade picture, Vietnam still stand out reasonably. If we look at the chart on the left-hand side, so basically we see the robust trade picture for not only Vietnam but other export-oriented economy like Singapore, Malaysia, Thailand, Philippines, and other countries. But we are significantly outperforming Philippines and Indonesia, quite in line with Thailand, and a little bit slower than Singapore and Malaysia this year because of our best performing last year. And in terms of the export turnover, we are ranking second, only behind Singapore in the first 5 months of the year. We have 5 months because that is a comparative number with the data released from other economy. Something that the investor are concerned recently regarding to the implementation of the Section 301 and the expiration of the Section 122. But from this picture, we can say with very high confidently that it's not impacting marginally to the trade picture of Vietnam, because Vietnam remain very competitive, and just a little bit of raising in the effective tariff rate from less than 11% to 11.7%. And we are still have a lower effective rate according to our calculations than Indonesia, China, Bangladesh, our key competitor, a little bit higher than India and Thailand. In terms of the breakdown for the tariff by sector, so basically we see the machinery and electrical that accounting for more than 60% of the total export to the US still enjoy very favorable tariff rates. However, for other sectors like textile, footwear, and furniture, we see it kind of challenging for especially for the domestic sector and labor intensive as well. That's why we see the rising in terms of FDI contribution to the export of Vietnam to 80% from last year, 70%. That is showing the impact on the sector. And also we see very slow pace of growth in textile, footwear, and furniture below 5%. This is a slide showing the structure of the Vietnam trade activity with key trading partner. So basically, right now, the export to US accounting for about 32% of Vietnam total exportation, and import from China accounting for 41% of our total importation. We also see the risk of transshipment that raising the issue from the investigation from the US side, because there's a lot of things we are dependent from China. For example, 70% of our fabric coming from China. It is higher than the period before the tariff implementation in 2024. Similarly, also with machinery and equipment rising to 64% importation from China as well. And also the telephone is still very high reliant on China with about 83% of importation, and also computer electric component rising to 36%. Despite that, Vietnam remain a very attractive for FDI investment. As we see from this picture, the relatively competitive in electricity price, only I think a little bit more expensive than Indonesia in terms of the industry electricity price. Also, Vietnam have one of the most diversified FTA with other economy behind Singapore. But regarding to the ranking for the FDI preference for Vietnam, so Vietnam is very open, even higher than China, Indonesia, Malaysia, and Philippines in the region. One of the things we see is very big improvement from the current reform of the government is last year, when we look at the survey by Eurocham last year, so for most of the time, the infrastructure is a key concern for the FDI firm. However, at the latest survey in the second quarter of this year, it becomes the less concern for them. And instead, the administrative procedures still the largest concern for them. So that is the thing that we still see is going on with the National Assembly have an abnormal session today, because there's a lot of new law to be revised and ongoing consideration for revision in the future. Regarding to the other ongoing investigation under the Section 301, that has a risk of a higher tariff from this current level. So obviously we see the risk because Vietnam right now is in May become the country that have a high source of the US deficit, and in the first 5 months we are ranking the second behind Taiwan. So that's why we see a lot of investigation coming from the US. However, from my point of view, I think regarding to the risk of the illegal transshipment and the evidence, it is still there's no strong evidence found. It's required technically, but basically from what I discussed with some of the high-ranking officer in the government, so we think there's a kind of the difference between the method of filing for the country of origin for the good export to the US and for the good import from other country to the US. From Vietnamese side, so the government, they issue the CO. So that means they can monitor 100% of the goods that are exporting to the US. However, from the US side, they somehow they using a kind of self-declaration system. So that means likely there's some other good from other country, but if they self-declare that they have the background from Vietnam, they can be counted from the West side as the value of the import coming from Vietnam. That's why we see the chart on the right-hand side, the bottom, is a difference between the reported figure by each side with the negative numbers showing the difference between the Vietnamese and the US side. And that's raising the concern for the US regarding to the transshipment. But from the Vietnam, I think the government, they have so many strong evidence that there's very little evidence found in transshipment case. We will discuss more detail if you want to have that later. Regarding to the domestic consumption, as I mentioned, so regarding to the number of retail sales rising about 13% in the first 7 months. But what I want to discuss here is regarding to the tourism sector is Vietnam rising to the second place in terms of the most crowded international visitor in the first 5 months of the year. And not only by the number, but also by the performance. So Vietnam is the only country have more than 100%, actually 145% of the level before COVID-19. Meanwhile, other countries in the region is still struggling below the level that we experienced from the level before COVID-19. So it's showing that there's a lot of improvement in Vietnamese government to trying to boosting that sector. Regarding to the investment activities, so as I mentioned, a good point is we see the rising in terms of the public investment acceleration, especially in July. And not only that, for the foreign investor investment, we see the rising very big jump in terms of the commitment value, in terms of the capital contribution value in the first 7 months of the year. So that is showing that foreign investors, they are very confident on Vietnam in the long term. One of the points that someone asking me regarding to the level of the state budget, despite the estimated deficit of about 3.8% of GDP for this year. However, in the first 7 months, Vietnam still have about 470 trillion Vietnam dong in terms of the state budget surplus. That also showing one of the factors showing the difficulty, the lack of liquidity in the money market, because we have more tax collection from the government than they're spending out. Regarding to inflation, so despite inflation is still above 4%, but it actually showing the sign of cooling down for 4 consecutive months. And actually, month-on-month basis, it have negative number in the last 2 months. And it's still below the 4.5%. So we don't have any worry, concern right now regarding to the risk of the central bank in Vietnam have to raise the policy rate like other countries in the region, as I mentioned in this slide. So many countries in the region, they have to raise the policy rate because inflation rising. For example, like in Philippines, Indonesia, Japan, and Europe, and even the US. And Vietnam, though, thanks to thanks to the interbank rate is and the swap point now returned to positive. So Vietnam đồng performance is quite good at the first 7 months, broadly unchanged, and among the top performance among our key trading partner currency. However, in the period between 2022 until now, Vietnam đồng still among the worst performing currency, losing about 14.2%, and explaining one of the reasons why the foreign investor keep selling on the FII perspective. Now, I think that is a summary for the macro picture. Now I want to turn to the link to the today theme is a disconnection between the macro very strong with the market performance from my macro perspective. So first of all, the central bank in Vietnam, because of the high liquidity in the commercial banking sector, so they actually suspend the bill issuance. That means they suspending the withdrawal in the open market operation since last year July. However, because of the maturity of the injection of the lending activity in the open market operation, so right now the current outstanding is about 172 trillion Vietnam đồng. That means about 60% lower than the peak at the beginning of the year. And that also may explain the reason of the poor performance in the VN Index. As we see that in the chart on the right-hand side at the top, we see that generally we see the net injection of liquidity during the month support the market performance and vice versa. For example, in the last 2 months, we see the net withdrawal due to the maturity of the lending activity from the central bank of Vietnam to the commercial bank of 87 trillion and 73 trillion respectively, and the VN Index down 0.2 and 6.7% month-on-month respectively. And secondly, we also see the on a more high frequency data, we see the VN Index performance is quite inverse relationship with the overnight rate. Right now, we see the overnight rate declining, and we see immediately the jumping in terms of the VN Index performance, not only for this time, also for other period of time, as we see clearly on the chart at the bottom. This slide also I have reported last few months ago. Now I updating for the first 7 months of the year. What I want to try to say here is seasonally we see somehow the worst likely is over, because if we look at the mean performance of the last 20 years from 2005 until 2026. So basically, we see July is one of the worst performing months, with the month-on-month performance of the index down 0.1%, and this month last month we down 6.7%. However, August is often the best performing month, with average return of 3.9%, only behind January. So that means we see a kind of good sign on the seasonal, on the historical pattern. The second good sign is regarding to the interbank rate, as we mentioned on the previous slide. So interbank rate is actually declining, despite sometimes jumping, but on average July declining to 4%, and it's quite in line with the historical pattern as well. We can see on here. So we see the pattern is between July until November. November often is the month that we see the interbank rate have average rate is lower than in the other month. So I think that's some of the key points. And before I hand over to Tyler for more detail regarding to the stock performance, I would like to update on the a little bit of longer term picture. Just 2 slides for you. The first thing is what I discussed with the government. I think So far, the government is very affirmative, very strict with the 10% growth, not only for this year, but also for the next 5 years. So that is very, very affirmative goal for the government, and we see no sign of changing this target. And secondly, so that means it is very challenging because statistically, on the right hand side, we see no country from our level, 5,000 US dollar GDP per capita, can rising up 10% in the next 15 years. The best performing is Singapore at 8.3% and South Korea 7.7%. Even Japan only they can grow from 5,000 level at 4.4%. But surprisingly, they still can become a high-income economy. The reason why is because actually during the period between 1975 and 1989, the Japanese yen appreciated against the US dollar by 2 times. So that means the currency stability is also very important for a country to become a high-income economy. Now, regarding to the driver for growth, we mentioned more about the investment. Why? Because when we look at some country from our same level, 5,000 US dollar per capita, so no country have our low level investment to GDP. Currently, we have 33%. But other countries like Singapore, Japan, and South Korea, they all have more than 35% at our same level. Like China, 45%, Singapore also at 45% at our current level. And also we have a good point is we don't have to worry too much about the efficiency of the investment, because it seems like from our calculation for 2025, the efficiency level has been improving significantly to 4.3 times for the I-core ratio, and it's even lower than the government target in the next 5 years of 4.5 to 4.8 times. Now, if Vietnam government can achieve the target in the next 5 years, so Vietnam can have the same income level as Thailand. So it's a very good picture for Vietnam. However, if not, so at least we can still see the IMF forecast is very conservative. We still somehow in line with Indonesia and Philippines level. And the last chart I'm showing is the chart on the right side is showing the need for the total investment that is coming from the state sector, from the FDI sector, and from the private sector is about 1.5 trillion US dollar. With the number in respective year, we highlight in the chart on the right side. For this year, we estimate about 230 billion US dollar. So thank you for the attention for my sector. So I would like to end my presentation here today. Please, if you have any question, please don't hesitate to ask, whether now or after the, I think after the Tyler slide, I think.
Yeah,
Yes.
thank you very
Thank you.
much, Dr. Long, for providing that rock solid macro crowding and still having some concerns such as the inflations or trade deficits. But overall, it's clear that the macro engines is running strong. Yes, at the institutional investor, the pressing questions remain. Why isn't this momentum driving immediately gain in the stock price performance? And to bridge this gap, explain the disconnect and show us exactly where the alpha lies. Please welcome Tyler, our Chief Market Strategist. Tyler will try both our second and third chapter, discussing about the explaining the disconnect and the strategic playbook. Over to you, Tyler. Thank you.
Thanks, Yehan. Good afternoon, everyone. It's a great day today since we get to do a presentation when the market is a bit on the upside. So it's great to see that. We have quite a fair bit to share with you, but because the content is quite long versus the timing we're quite tight, so we're probably going to go very quick on the slide, and let us know if you have any questions later, if you want us to present it in more details. So in terms of the content of the presentations today, I'm seeing a lot of the familiar faces in the list of joining participants. So probably we'll skip quite a fair bit and talk about mainly the liquidity factor. The main reason why Vietnam has been not getting enough attention, and what is happening next. So in terms of the thoughts, we'll go straight to the point. Number one, we did a presentation in June 2026 in tandem with our strategy release for mid-year, and we maintain our target index for 12 months about 2,000 points plus, and that hasn't changed. And we're still not changing that. In terms of the earnings growth, it's 26% for FY26, 12% easing down on FY27. However, that would bring the 12 months forward PE down to about 9, been seeing a bit of a correction so far. In terms of the short to mid terms, we still continue to see that there will be volatilities, obviously due to what Anh Long just said, inflation. We have fuel cost uncertainty, energy supply, liquidity, and also rates is still quite elevated. For fourth quarter, we will see stabilization. So that's what we are aiming at. Now, there's some changes in our thoughts for the market. Number one is the Prime Minister is a technocrat, so we expected that the policies will be towards the stabilizing macro. What happened is that the policies has now already been implemented and mainly focusing on the fundamentals. And also, like Anh Long mentioned, the government is very determined in the 10% growth, and they're trying their best to do so. In terms of the upside, last time the old view was looking out for FTSE EM, picking rates, MSCI, IPO, FDI, and public investment. Now, what we are seeing is that it still remains true. We're expecting on the 21st of September, there will be roughly about $200 million to be bought in by ETFs, focusing on a basket of stocks. So that would be a big liquidity boost. Rate picks at year end, still our view. We see the healthy IPO pipelines and also public investment is picking up. In terms of risk, we did expect a liquidity-driven retracement in June 2026, and it did happen. The market did retrace for about 10% from last time we spoke up until now. And we saw the lingering downside is still there with the macro risks, obviously from both local and global. In terms of the strategy, we did emphasis on buy on dip strategy, particularly blue chips. We don't think that you should buy in basket, but more on a selectively style because valuation back then was already decent. And now, since we're already about 10% down from that point of time, we think that, there's a lot more choices. But again, we're still focusing on selectively blue chips that we really mentioned. So what are those? We maintain exactly the same choices that we made earlier, which is banks, consumer, brokers, industrial, and we do watch out for a few IPs and tech names. Now, what's next? We'll talk a bit on earnings because earnings has been quite good, very resilient, beat our expectation and also street expectation. Forward looking is actually still quite stable. What we saw is that in this table, VNO share, everything was up in second quarter. PATMI was about 50% year-on-year grew with big improvement in big and small caps. If you look at the HSC coverage of VN index, we're all also up about 45 to 55%. So everything is very healthy. Now, in terms of comparing versus our forecast, if you look at the coverage that HSC is doing, obviously we're covering the most in the market. We see that most of the column of the forecast is beating our estimations. So most of the sector is actually doing very well in terms of second quarter, which is quite surprising because we were expecting some sort of like a margin compression due to the higher energy costs that happened due to the Iran war recently. In terms of the valuations, we expect that the correction is about 70% done. Still, there will be some residual retracement, but that would represent a lot of the buy chances in the market. Obviously, not buy everything right now, but there will be a residual retracement. and you'll be able to get quite cheap pricing. Why? If you look at the index versus the Vin Group exclusion, you see that the VN index did not really go up at all. And if you were to look at 2024 up to 2026 now, the implied trailing PATMI is actually going up, excluding VIN trial, okay? And then the VN index continue to move down, leading to the fact that, you know, that there's a big disparity between the broader market versus the VN index. So in that sense, then we think that, you know, the valuation in a lot of the selective stocks is already actually looking a lot more attractive than the surface. If you look at the index trailing, excluding the VIN trial, we're actually at a -2 standard deviations of about 5 years now, which is about 10 times. That is about 20%, 20+% discounted from the average that we're actually looking at usually in Vietnam for about 14 times. If you look at the regional markets and the valuation, so obviously we're using all Jose companies, not excluding Vin Group, and even with that, right, the valuation is actually also at about 11.7 times trailing, right? We're not even talking about forward, and usually Vietnam has a discount versus regional peers about 10, 15, 20%. And even that, and if you look at comparing Vietnam to Thailand, now the discount is a lot steeper at about 30% odd. So that is something to note because we are discounted heavier than the regional peers. And even that, then we do see the index performance not doing so well, but EPS growth is still good, ROE is still good, GDP growth is still good, and depreciation over the past 5 years actually not too bad versus every other regional markets. So now what we are trying to see is there's always like the earning yields benchmark against interest rate. And in the past 7, 8 years, what we saw was that there were 3 times when there was a hike in interest rate, and interest rate has a big inverse correlation with the VN index, like Dr. Long just mentioned. And obviously, every time when there's a gap between earning yields and interest rate of up to about 300 basis points in the past, that was the bottom. Now, what are we seeing is that there's a 100, 200 basis point gap already at this current level. And we're seeing that, you know, if history repeats itself, then you're probably gonna, you're already about 70% or 80% correction is done. And most of the forward-looking corrections or retracement should be quite residual. In terms of FTSE disbursement, very fast. We're expecting about $200 million one-day execution, and that would be bought over a basket that we forecast roughly is a guesstimate, so it may vary quite widely, but that would give a big liquidity boost to this basket, and that would make up about 30 to 40% of the ADTV in terms of buying quite a significant boost at the end of September. So do bear in mind this kind of timeline. Now, in terms of the policies, which is quite liquidity related, it's still very supportive, and it's aimed towards improving liquidity, in the market. So there's a bit of, AI drawn, figures that we try to also add a bit of the personal touch, the human touch here. But what we're seeing is that the banking sectors are having a lot of the policies supporting the liquidity and try to release some of the funding pressure, in the market. It's not yet, in a way, significant to the market just yet, but policy takes time, 3 to 6 months. We're probably going to see some of these policies, taking some effects. We also never seen before a Vietnam financial market development plan. Every other sector, from electricity to aviation to roads to bridges to infrastructure, there's a market development plans officially signed by the government. But in Vietnam financial market, we barely see such an extensive development plans that is officially signed by the top management, which is highlight over here. So we also summarize it for you to see and send you the slide later. There's a focus area and also the key target and KPIs in the next 5 years or so. In terms of the decision 1743, which is also state treasury terms deposit count towards the LDR increasing, so that is also trying to aim at temporarily improving the liquidity issues in the market. Another liquidity related issue is alternative assets are actually trending down. So in Vietnam, there's not a lot of assets that you actually can buy. And obviously, with this kind of environment, then we're seeing there's a chance for liquidity to go back to the stock market very soon. If you look at alternative assets, we look at gold. Gold has been sold down, after the diamond scandal recently, then people also starting to sell gold. A lot of them actually speculate. And if you see the shaded area, there is actually the gap between the HSC gold price and also global gold price. The gap actually narrowed down quite a fair bit. That provides quite a fair bit of liquidity in the economy itself. In terms of US dollar, also again, because of that, then the free market rate versus the Viet Combine rate is actually the gap is also narrowed out quite significantly to almost zero right now. Interest rate, which is fixed deposit, is considered as one of the assets in the economy that we can buy in Vietnam, funny enough. And interest rate has been going up quite a fair bit. So we're expecting that, this is actually a very attractive level, and that would eventually kick in and provide incentive for people to put in more money into fixed deposit. And true enough, we saw deposit growth starting to increase since June and July in 2026, even though the gap, the LDR is still high and the gap is expanding, but obviously people are starting to put more deposit growth at this kind of level. So we think that is the interest rate may not have more room to grow, may residual rooms, right? But little room to grow, sharper. That also explained because the funding needs, the funding needs in the economy is still quite high. So that's why we still see a widening credit deposit gap in the banking system. But that should normalize very soon towards the end of the year. That's our view right now. In terms of another asset is the property transaction, right? It's also going down since the deposit rates, the interest rate is going up quite a fair bit. So if you think about it, most of the assets in Vietnam are actually not attractive at the moment and going down, and where the money should go. I think they should eventually go to fixed deposit and eventually partially solve the tightness liquidity in the system in Vietnam. So that's what we are seeing. One more, which is crypto. Surprisingly, Vietnam is actually among the world's top 10 crypto adopting countries. And with the pricing of crypto is also going down, recently the hype of crypto in Vietnam is actually easing quite a fair bit. So we do think that some of this kind of money should eventually go back and find distressed assets, which is potentially equities, and that will provide further liquidities towards the end of the year. And also the last one, which is a public investment, that is liquidity related in this scenario. Then this chart we're probably going to see already we're about 40% only in terms of budget in 7 months. But if you look at the speed of disbursement on the monthly basis, then you see that we're actually in the past 3 months, the speed of disbursement is actually getting better. Month on month is double digit, 20%. Grow, and also you're seeing that the percentage of annual disbursement is also starting to inch up. Then what happened is, why we care is because if you look at the monthly ADTV of the VN index versus the state investment speed, they tightly correlated to each other. So when it comes to state investment, then we do want to see, if it inch up, then usually liquidities, lags a bit, but eventually we'll go back to the equity market. So that's what we see. And once equity, liquidity goes up, usually we have a bull run. So that's what we are seeing right now. Now, there's a bit on the fundamental side. I think most of people know, so I'll go very quick on these things, which is FDI. Very, positive FDIs, disbursement and registration is actually going up quite well. And if you look at these policies versus peers, this is what we found out is that Vietnam is very attractive still in terms of everything. Manufacturing labor costs, IP rental, standard corporate income tax, FTAs, depreciation versus US dollar, we are a lot more attractive versus the guys like India, the Philippines, Bangladesh, or Sri Lanka. Electricity price, again, like Long mentioned, we are actually very competitive. We're cheaper than most of the peers. So therefore, FDI will continue to be, a core growth driver for Vietnam. We'll be seeing more FDI coming in eventually towards the end of the year when more visibility is on the text in the tariffs from the US side, it's coming out. Politics, we think there's one new thing about politics, so there's like a mixed view between politics in Vietnam. Some say that, we are going to a dark era of, of socialism. And some is saying that maybe there's a side to look for. We do see that there's some execution is a new catalyst. What happened is we did have major infrastructure projects that are compounded here. And what we're seeing is, unlike in the past, most of the government infrastructure is having a very fast execution speed, including railway, highway, airport, you named it. So there's so many that is actually being built right now. And we did track the execution speed and the progress. And so far, you look at the coloring, which is, green here, there's a lot of green, and if not quite in line with the speed that they put it in the beginning. So we've summarized quite a fair bit about, I think, about almost 20 mega projects right now that is being, constructed across Vietnam, and most are actually faster than the planned execution. Now, these are just some, pictures for you to see the whole Vietnam is becoming like a construction zone, everything from north to south. Now, the final one, which is the capital market reforms, we have CCP, FTSE, MSCI, EM in progress, and so IPO. So we've done that in our previous presentations, and I'm not going to repeat that again. Just want to recap on what is actually going to happening. CCP, these are the roadmaps. IPOs, we do see a healthy pipeline. So we saw DMX already in there. We're looking for F88. There's a lot of other interesting names in the pipeline. The VAC is also there. Highlands Coffee is also there, and there's a few more, brokers also coming into the picture. So that is quite different, and we're expecting that in 2027, this is going to be a key liquidity attraction, catalyst for the market. Flows. Now, in terms of flows, there's quite a fair bit of a supportive picture over here. Number one is that we think, the hyped in, AI, obviously we are not really AI specialists, but we do see that comparing to the dot-com bubble, then there's some similarities in terms of valuation craziness. And what we are seeing is that the valuation is coming to a point that AI valuation is becoming unjustifiable, and there will be a correction at the end of the day. What goes up must come down. That's what we saw. We are seeing that in Korea already, in Taiwan as well. And with that, the money will flow back to the traditional manufacturing or emerging markets. And we are already seeing that in Thailand. And obviously, not to say to compare, but Vietnam and Thailand both has catalysts. And we do see that in terms of macroeconomics and political stabilities, then Vietnam do offer an edge over Thailand. And yet, for Thailand, the flow has been very supportive versus Vietnam. It has not. But if you look at the monthly flows, net foreign flows in Thailand and Vietnam, then you can tell that Vietnam is gradually improving, whereas Thailand is mega boom, right? So if what happens to Thailand easily go to Vietnam, and we think that, from September, this might be the picture. Foreign ownership also at the lowest possible point now is about 13.3% of the total share outstanding of the market. And with the foreigner keep on selling, then the margin loans is also going up to accommodate that kind of selling. However, if you look at the absolute number, it's a bit scary. But if you look at the margin on equities from fourth quarter 2025, it's actually quite okay. The marginal equity is still at a safer level and not picking in by any means. And there's a lot of the raising plans of notable brokerage firms that we compiled here, listed names and non-listed names for you to see. And we do see that there's a lot of substantial additional buying power in the market. And we are not worried too much about the margin levels. Now, very fast, and the last one, which is the downside risk, we will try to compile all the possible downside risks here. And there's just a discuss and our rating on the concern. Number one is the global growth slowdown or US recession. Our concern is medium. We don't know for sure, but we think that is a low chance of happening. We do see a risk of the stronger US dollar and FX pressure, high global yields. We do see geopolitical and trade risk is there. However, it's slightly lower than the US dollar. We do see the risk of further lack of liquidity in the economy because, like Eng Long mentioned, 10% GDP growth, and the government is trying to achieve that by infrastructure built. And that is the reason why there will continue to be more demand on liquidity. And that is something that, there's no way out just yet. And that would keep the interest rate elevated for longer, which is not that good. So it's the high impact, but it's going down to medium concern because we do see there's some light at the end of the tunnel towards the end of the year when interest rate can come down. If you look at the deposit rate growth is actually coming up. Global energy price and other concerns, and there's a few things which is low and if not becoming a catalyst rather, which is the earnings recovery, delay in policy execution, and also real estate recovery. So real estate recovery, we do see that, it's probably going to recover towards the end of the year as long as the interest rate maintain or just showing signs of easing. Now, we have this final table, which is the comparison between the macro risks across the years in Vietnam. Out of the four major crises or corrections in 2011, 2018, 22, and 26. And what we're seeing is that, the index corrected quite a fair bit during the past 3 times, but extreme tightening, monetary, bad debts, real estate, and the short trade all are worse than current level. So comparing now versus 2022 is a bit too bearish to our understanding. Obviously, when the share price comes down, then people tend to become negative. But we do see that, that is not really the case here. Fundamentally speaking, monetary indicators were also a lot better. We might be having some moderate control on real estate, credit access, and rate pressure, but that is nothing compared to 2022 pressure or in 2011. We do see some credit growth versus target is a bit high, but it's not as high and not alarming as compared to the past also. If you look at the macro indicators, we're also very good. Just a little bit concerned on the private credit over GDP, but again, it's nothing out of control at the moment. And valuation and also the earnings is much better versus the rest of the years. So interest rate usually go against the VN index, and we're already seeing interest rate is somewhat finding its peak over here, and that is the reason why we think that it's time for gradually picking up quality names that you want to actually have for the longer position. Now, talk about that. Last but not least is our pick. So there's so many choices in the market right now, I have to admit. Everything is cheap, so it's a bit difficult to tell whether, TCB is going to perform higher, faster than VPB, but we're probably going to use our flavor and just choose. But we have a pseudo portfolio here for you to see. Again, we still prefer banks. We like consumers. Unfortunately, with P&J, then we couldn't really put it in because of the scandal. So we lost one of the very easy to recommend name there, but we do like the brokers. They're very volatile, but we do see that the price, they are quite priced in the high interest rate and the reduction in NIM. We do like industrial sector, and also you should watch out on some IP names. It's incredibly cheap right now, even though it's kind of small. So we have a few names, especially the banks. We like the banks a lot. The banks have been discounting about 20% from the average trading book value. Usually in a trough period for VN index, you see that the banks goes down to slightly 10 or 15% below book value. The most recent one is the VATIFA. Most of the bank goes to book level or below book level about 15%, so 0.9 times book value. So that is absolute worst. So therefore, right now we're looking at the banks averaging from 0.2 to 1.2 to 1.3 times book value. But if you forward, then you minus about 15% off then you're talking about forward book is about 1.1 to 1.2 times book value on average, which is kind of fair to us, you know. Obviously, it could be cheaper. I wish it could be cheaper. But I think the names are the same. And if there's any chance that there will be a residual correction in these names, please by all means, you know, pick it up for the year-end rally. We do see that there's some value here, not extremely bankable buy at the moment. But if there's an additional 10% or so discount, we like the banks. Move on to consumers. Again, I think it's quite stable. Also discounted quite a fair bit. So the consumer, the usual name, NWG, DGWO. We like the brokers. So the brokers have, because liquidity, we think that it's going to go back. So now it's probably the bottom of liquidity. And usually these guys are very sensitive to two things, interest rate and liquidity. And interest rate is already peaking in our view, and also liquidity is also bottoming out. So we do see some values that's already been discounted also. If you look at SSI, VCI, TCX, that, well, TCI is just newly listed. So let's look at like SSI or VCI. Usually, right now, they're actually discounted about 30 to even almost 40% on their average book value valuations. So we do see some, incredibly discounts there. We like, an IP name. So IDC is the go-to, and a few other various sector, which is, the steel, the port, and also one energy name. So that would be our pseudo portfolio, and that also concludes our presentation. Hopefully, we're not too off from for the time being, Tian. Yeah,
Yeah,
that's
thank you,
yeah.
Tyler, for outlining the strategic playbook and identify those clearly pocket of the infra. And now I'm going to step out of my moderator role for the next 5 minutes to put on my sales and trading desk hat to cover the chapter 4 trading tactic. And we just have laid out the destinations of the what and where. Our deck chart is to give you the executions, strategies, and entry timings, the hows and the when. Moving into the sales perspective, let's address the core phenomenon we are seeing right now, the scratching valuation disconnect. Dr. Long and Tyler outlined the broader market have been heavily weighed down by the systematic liquidity tightening, persistent forex net selling, and in fact, if we look closely at the VN index, um, it's heavily concentrated on the few specific clusters, including the Vin Group names, STB, or LP Bank. And if you strip out these select heavyweights, the rest of the market has experienced a significant corrections, causing the valuations of fundamental solid company drop to the highly attractive level, as Tyler recently mentioned. And this brings us to the first major concerns keeping the institutional investors on the sidelines, the fears on the fears the fears on the overheated margin lending environments. As you can see on the slide, total reported margin balance hits a fresh record high as around nearly $16.5 billion in quarter two. And this huge number might seem worrying at the first glance, but if you look at the deeper, the actual step up is much healthier than the market think. In next slide, you can why do we believe this leverage is still healthier? Unlike the previous cycle where the retails throw the margin big, the current landscape is fundamentally different. Given the elevated domestic interest rate, retail participants have remained quite mute, and instead, this margin growth have been predominantly driven by the corporate owners, insiders, and major shareholders. And if you look at this chart, the corrections is clear. Correlations is very clear. Domestic margin growth is perfectly absorbed the massive $13.2 billion wave of the cumulated foreign net sales link in the end of 2022 until now. And essentially, the company founders, owners, and corporate insiders are the ones majority stepping in and using the leverage to back their own equity. And this representing the powerful vote of the confidence from the people who knows the business best. And furthermore, because the position reflected high convictions commitment between the brokerage firm and the corporate owners. So we think that the risk of these liquidations is quite lower. And granted, during the third week of July this year, we did witness the sharp pulse of the margin call and cross-margin call heavily triggered by the sudden corporate scandals at B&J's. However, historical rebate itself, um, just as we saw during the COVID-19 fallouts or 22 properties and credit crunch, the moment equity valuation dipped into the deeply discounted territories, corporate leader immediately launched the massive counter wave of the share purchase registrations. And this brings us to the next slide, which track the massive wave of the insider buying registrations filled between the July and August. And look at this high convictions volume across the major name like Candy, VCI, Mobile World, MGX, or PDRs. So we believe that these actions act at the vital sentiment floor following the sharp market corrections and historically demonstrate the large-scale corporate insider buying is the leading indicator that mid to long-term prospects have become significant undervalued. And next slide, we can take a look back historical validations on this slide. And historical doesn't just repeat itself; it follow the exact same patterns. And every single major market bottom over the last decade, whether it in 2018 macro recess or COVID-19 in 2022 or 22 credit crunch or even with the 23, we also always have the massive waves of the insider buying. And how do we trade this disconnect moving forward? Going to the last slide, we have the structure our high convictions idea into five interested macro teams. So research gives you the list of the best fundamental name. From the sales desk, we provide quite more multiple options. We have the team with the inflation big outs and rate relief. We have bank, we have brokers, we have the property plays or even the consumer plays. More importantly, and it will seen this or next month with the FTSE upgrade, 21st of August. The final list of the inclusion will be announced, so that could trigger the momentum towards the name within the list. And we think that like a Vingroup cluster, like Vic or Vinhome, Glex cluster, Hòa Phát, Masa, it could be gain the inflows here. We also have the big team in Vietnam in the next 5 years, infrastructure place. So that could be supported for like Vinhome, Hòa Phát, Gels, Bình Minh Plastic or CTD. We also have the fundamental name at the Tyler just mentioned. We have bank, we have consumers, we have the steel. We also have the for the last team, we think that amid the market volatility vulnerable. So some people like the defensive name. It could be dividend plays. So we have the bunches of um, high dividend yield per annum at around 8 to 13 or 14%. It could be like VEA, Bình Minh Plastic, Sabeco, Vinamilk, or IDC. So among of that, you can see we combine Vinhomes and Hòa Phát seem in the majority of team in Vietnam right now. So we have the bunches of the choice for you guys to take away. So that's a very quick view from sales and trading desk. That's also conclude our presentation now. So now we move to into the Q&A sections. So if you would like to ask the question live, please raise your hand and we will unmute yourself. Alternatively, you can drop your questions into the Q&A box. And we already have a very excellent queues of questions building up. So let's dive straight in. The first questions, Along, could you like to take this one? The Fed had recently signaled that it may raise interest rate again in September. How could this affect the Vietnam dong exchange rate? And good is Fox VN to maintain relative high deposit interest rate? Thank you.
Thank you for the question. I think that should really depending on the balancing purpose of the Central Bank of Vietnam between the growth, inflation control, and the FX. So a bit of that. So they will have to consider the balancing. For me, the risk for the VND depreciation is still a little bit there because we see the deterioration in terms of the balance of payment of Vietnam in the first quarter, and I also expect the current account of Vietnam turn to deficit due to the very high number of check deficit. So that together with the risk of the Fed raising the policy rate again, so I think we expect about 2% of depreciation from this level. That is my forecast. Even though we see the current situation is still very strong performance of the Vietnam year to date. But that said, it's also depending on other factors as well, like the local inflation level. Now we think inflation already passed the peak for this year, and that means the risk for our forecast of 4.7% is to the downside rather than to the upside. So that also can create a more kind of flexible room for the central bank to consider between control inflation, FX, and interest rate. Yes.
Yeah, but the investor also have the following up. That's what the trend for the interest rate in coming quarters, like the Vietnam policy rates as well. So can you share your view? Thank you.
Yes. I think right now the funding by the deposit market for the loan is just about, from our calculation, just about 87%. So that means the bank have to rely a lot on the other activities like raising the bond issuance. We see the current rate of bond issuance for the bank is highest level, even higher than the time of the bond crisis in 2022. Not only for the bank, but also for other issuer like real estate issuer as well. And in addition to that, I calculated that about 75% of the total funding raised by the first half of the year is by the banking sector. Raised, not raised, but and mobilization. The equity market, despite the very good performance, but only account for about 6% of the total fundraising. And the government bond market right now is just 22% of GDP and still very far below the government target of 35-33% in the next few years, as well as the corporate bond market, just 10% of GDP compared to the 25% of the target for the next few years. So that means as long as the funding need is still reliant on the bank sector, so I don't think that the level interest rate we will be going down soon, and I think we can discuss with more with our bank sector. But I think from the bank sector view, we think the interest rate should be at this level for a period of time.
Yeah, as like the Miss Hà, the head of financial team, expect that the interest rate should be stabilized at these levels and may slightly drop toward the year ends when the disbursement of public investment can be speeding up. Thanks, Long, for your views. And moving to the next questions, the fast state investment really boost the liquidities, and it's depending on when the government pay the vendors and ease their cash flow strain. Yeah, I think Long will
Thanks so much
continue
for
to
the
handle
question.
this one.
It's acquire a little bit of technical as well because if the government they collect the tax and they unspend the tax for the public investment, so the money should be kept like 50% of the central bank of Vietnam. So that means technically it is a withdrawal of the liquidity from the system. And for the rest 50%, they can be kept at the commercial bank, Big Four and NDB. And currently, we know that it has been raised technically from 20 to 50%, counting as a LDR. So LDR is just like a room allowing for the bank, for the Big Four bank to have more technically room for not exceeding the LDR requirement. But however, for the fund classify as a short-term funding for the long and medium-term loans. So actually, the deposit from the treasury is not counted as that kind of fund. But it's very hard to, to rectify what money is in for short and for long term. But even though it is still have more room for the Big Four and SMBB to raise by that. So that means when you see the higher disbursement rate, so that means there should be less money being withdrawn from the system and more coming to the system actually. So that is a good sign from my point of view. Yes.
Yeah,
Uh,
the investor.
Maybe
Oh,
I wanna add a
sure.
bit on these questions. I think right. Technically, we saw in the past, usually how the government execute projects is that they do land clearances, and then only then they start to hire contractors. And usually the money that fastest when it comes to disbursement is through land clearance settlement with the landowners. Or the buying of materials, right? Of construction materials. So that is the fastest pace in terms of the money that goes out to the economy. I have a slide here that I went very fast just now because of the time constraint. But if you look at here, the major infrastructure here, a lot of the infrastructure now is either under the land clearance progresses or under constructions, right? And usually when it comes to land clearance, then a lot of the money goes straight to the people. And what the people do is either they go and purchase something, or they go put in stock market, or they go in and acquire other land pieces, right? So it goes up every time when that there's like a disbursement in terms of the state disbursement. And if you look at the state investment disbursement, right, it always lags a bit. When the state disbursement goes up, and only then the liquidity in the stock market goes up, there must be like a bit of a lag time, so that, so to speak. So that is, I think, when the major infrastructure projects start to do a lot more land clearance, because a lot of them are actually in the planning stage. Once they do that, you'll be seeing the liquidity boost very soon.
Thanks, Tyler, for the adding colors on this answers. And the next questions is if the clients want to know where the liquidity have loosened, what leading indicator does the client need to monitor?
Hello?
Sorry. Hello, can you
Yeah.
hear me again?
Yeah.
Okay.
Can you hear
Really
me?
sorry for yes. We
I
can.
think there's some kind of disconnection. I don't know why.
Yeah.
Okay. Yeah.
I see. Just now I
Yeah.
saw you guys were standing still. Yeah.
So
Yeah.
can I
But
Okay.
continue?
I think
Where were we
yes.
now?
So the client questions is which is the leading indicator to see when will the liquidity to be loosened? Yeah. Thank you, Anh Long.
Yeah. So in short, so I think the interbank rate is falling. The liquidity of the daily interbank market is falling as well, and less of activity in the open market operation from the central bank. So that's the side of improving in terms of liquidity. Other indicator I also keep checking is cash level of the S% of liquidity. So currently, I also think the cash level is declining. So that means more deposit coming to the system. So that also helping for improving of the liquidity.
Yeah, that's clearly answered. Thank you. And the next question
I think
is
one
about.
more. Hello?
Okay.
Can you
Yeah.
hear me?
Yeah. Sure. Go ahead.
Yeah. Maybe I think there's another way to do is through market checks. Usually what we do track whether the liquidity in the market is abundant is by the amount of money top up by high net worth individuals across the brokerage house. What I do is that usually over a month I talk to the head of remisiers, right, in some brokers that I know to see if the clients actually top up the buying power. Like today, some big net worth, high net worth individuals bought in, but that is just a very initial sign. So usually, if we do surveys once a month, then we can see whether the liquidity, levels in the market may have a sign to go back or not. Another way to look at is the shadow margin lending activities. Usually in Vietnam, that's not really legal, but not really illegal. But what happened is if they actually go back to business and start to launch offerings again, then I think also that is the indication that the market is ready for buying. For now, at this moment, we don't see those two actually in line. There's some buying from high net worth individuals today, but it's not a big wave of topping up monies in. And also another, offerings from shadow margin lending is not there yet. It takes some time gradually launch up. Another point to note is the demand for margin deals. So margin lending deals. Usually, if let's say the market lacks liquidity, then the margin lending by deal cases, right, goes up. So that indicates that the company needs money for their or to fund their operations, rather than let's say you have more margin lending from the retailers, big retailers, the mass retailer itself to go and buy stocks. So right now we're seeing that the increase in margin lending are mainly deal basis. So again, right, we haven't seen that coming, but those are the three additional points maybe you want to track.
Thank you, Tyler, for your answers. The next question is, do you think that the government will keep the credit growth at unchanged 15% for this year?
Yeah, the government they will never explicitly saying whether it's 15 or not because they say it depending on the situation. But for me, I think if we see from the current action of the government, and if let's say like in the last quarter of the year, they think they can control the currency, the FX at below 2%, 2.5% of depreciation, and also the inflation is below 4.5%. So I think there will be more chance that the cash flow will be higher than 15%. Because why I say 2%? Because in the depreciation, because what I observed in the trend of Vietnam Dong in the last 25 years is Vietnam Dong losing 2.5% each year for the last 25 years. So that means if this year the Vietnam Dong is losing about 2.5%, it's still very in line with the long-term trend.
Yeah, and in addition to that, so as a recall, that's SPV recently also announced the 18 national
Yes.
project that's excluding from the credit growth quota as well. So if we
So that is
including this,
adding
so it's
another 1 percentage point. for this year.
Yeah, 1.1%
Yes,
for this year, and also coming up to
on the
be
next 3 years.
dispersed in 2027 and 28 as well. Yeah, so
Yes.
technically it's also considering at the higher than the allowing
One
15%,
more,
right?
one more thing is that only three big group. There may be the precedent for other group to doing so, because we see from the public investment number in the first 7 months of the year, Hanoi had the highest growth in terms of public investment, according to NSO release this morning, rising by almost 70%. So we see there's still many projects to come. So that means that's good. And from the private sector contribution.
Yeah.
Yes.
Yeah,
Yeah.
agree. Thank you, Anne. And moving to the next questions, I think Tyler can help us to answer this. Why do we exclude the Vin Group when assessing the market? And given that it is a key driver of Vietnam economy, benefited from the strong government support, and it also expected to benefit from Vietnam market upgrades. Thank you.
It's the questions that we've been asked for the past, I don't know, half a year on Bean Group, and there's like tons of headache that we've been getting from this name. Well, I think number one, to answer you, we do not just only exclude them out, but we do have two scenarios that we never had that before, right? So one scenario is to exclude Bean trial, and one scenario is to combine together. Usually when we combine all together is when we want to compare to regional peers. So with that kind of scenarios, then we are still seeing that Vietnam is more deeply discounted versus the usual discount of about 10-15%. Versus, right now what we're doing is about 25 odd percent to the regional peers. So that's number one, to show that we're actually cheap even with Vingroup. Now, the reason why we need to exclude Vingroup out, or Vin trial out, is because they've been performing way too well, and the valuations of Vingroup is hardly can be justified fundamentally. Obviously, the share price move way too much, then it creates a lot of headaches for the fund managers, because technically nobody can overweight Vingroups. You can have some, you can have a lot more, but hardly you can market weight it, and usually people underperform because they perform much better versus the market in general. So our questions, our aims to exclude them out is to see whether you still have chances for the rest of the market if you're in that position that you don't really have in group. And I don't think you can really, if you have a very sizable fund, right, you can actually have any ways to overweight in group right now. And even if you can overweight right now, nobody has the the guts to overweight at this kind of price. So is there any other way or any other strategy that you can in a way find values elsewhere, and then not having Vingroup as an overweight at this moment, right? Regardless whether your fund is big or small, then we do see some values, and that's the reason why we took it out, to see how much was the discount to the broader markets, and then from then we can start to pick up, because we do see that when there's one stock run, there's always a laggards. And picking the right laggards may give us the rewards. We're not saying that Vingroup doesn't run further, but I think there's a lot more logics to bet on things that is fundamentally good and has been depressed and laggards for the past half a year or so. That's why we have two scenarios and trying to see how much the rest of the market has been discounted and is really good bankable buy just yet. There you go.
Yeah, thanks, Tyler, a lot for your very comprehensive answers. And this is our final questions, and we conclude our webinar session today after nearly 1.5 hours of discussions. Thank you, everyone. I want to express my sincere gratitude to Dr. Long and Tyler for their brilliant insights, and more importantly, to all our clients for your time and highly engaging questions today. And if we did not get chance to answer your specific questions, please do not hesitate to reach out directly with your salespersons, and we will make sure that to get back to you immediately. Thanks once again for partnering with HSC. Have a wonderful week ahead. See you in our upcoming webinar event. Goodbye.